If your household income is well into the high six figures, or your net worth exceeds $8 million, the next 14 months may be the most valuable tax planning window of your lifetime. The rules that took effect when the One Big Beautiful tax bill was signed in 2025 give you a chance to reposition well before 2026 locks in permanently threshold. Today we will cover 3 powerful strategies: free and grow, give now, and shift income, so you can protect what you have built, reduce future estate taxes, and pass wealth efficiently. Here's what you will learn. We are breaking this video into 5 clear parts. So part 1, we're going to talk about the first strategy, where we're going to talk about freeing the growth. Part 2, we're going to talk about the next strategy, give now. And part 3, we're going to talk about shifting income. Part 4, how can you coordinate with your business entity. Part 5, your 2025 action checklist. Along the way, I will give you stories, examples, and bonus tips you can apply right now. If you are a high income earner, or a business owner, or an investor with appreciating assets, this video is for you. So grab a notepad, because you will want to capture this step before year end. Let's take a look at the big picture. Why this window matters. The federal estate and gift exemption increased to $15 million per person on January 1st, 2026. So that's $30 million for married couple. The IRS had confirmed that gifts made under higher exemption aren't clawed back later. That means any transfer you make now is permanent and fully protected under current law. But here's the catch. Appraisals, trust drafts, and legal documents take time. Many professionals are already booked through December, so you will need to act in the next 10 weeks to capture the 2025 window and be ready to execute larger transfer when 2026 begins. Now let's start with part 1, which is freeze the growth. When we say freeze, we mean locking in today's asset value inside your estate and letting all future appreciation growth outside your taxable reach. If you own rental properties, a closely held business, or an investment portfolio, this section will make a huge difference for you. We will walk through 3 ways to freeze value. 1, a family limited partnership or managers managed LLC. 2, an intentionally defective grantor trust. And 3, a grantor retained annuity trust. Let's break down each one by step. First, let's talk about family limited partnership or LLC. So think of this as creating a box for your assets. You form a family limited partnership or an LLC and move appreciating assets into it. You keep control through voting units and give non-voting interest to heirs or trusts. Those minority interests can qualify for 10 to 30% valuation discounts, allowing you to move more value while using less exemption. I want to tell you a story about the Honolulu portfolio. So Lani and Daniel in Honolulu own 3 rentals and a landscaping business worth about $12 million. In October 2025, they formed an LD Ohana Holding LLC, contributed their rentals, and issued voting A units to themselves and non-voting B units to their children's trust. A certified appraiser supported a 25% combined discount. They gifted part of the non-voting units in December 2025 and sold additional interest to a trust in January 26 for a promissory note at the applicable federal rate. Now, over $5 million of future growth will occur outside of their taxable estate. Let's go deeper into freezing growth. If you want to push even more appreciation out of your estate, The next strategy is an intentional defective grantor trust. Here how it works step by step. Step 1, create an irrevocable trust for your heirs. Step 2, seed it with a small gift, usually 10% of the amount you plan to sell. Step 3, sell appreciating assets to the trust for a promissory note under the annual applicable rate. Step 4, you keep paying the income tax on the trust earning so that a tax-free transfer of wealth every single year. Let's look at another example. The Seattle founder, Maya and Chris from Seattle, they sold a software company but retained private fund interests that keep growing. In December 2025, they seeded a grantor trust with $200,000. In February 2026, they sold $6 million in fund interest to the trust for a 9-year note. All future growth belongs to the trust. They still control the investment and quietly ship their wealth to their heirs each year by paying the trust income tax. Now, the third phasing tool. If you hold concentrated stock or pre-IPO shares that may explode in value, a grantor retained annuity trust or GRAT can lock in today's price and move excess growth to your heirs tax-free. Now let's talk about grantor retained annuity trust, which is GRAT. Step 1, transfer your stock or partnership interest into a GRAT. Step 2, you receive a fixed annuity for 2 to 3 years. Step 3, any appreciation above the IRS Section 7520 rate, pass it to your heirs with little or no additional gift tax. I want to share with you Raw and Austin. Raw run a hardware manufacturing company and expects strong growth in 2026. In February 2026, he created 3 short-term grants and staggered the start dates. When his company stock outperformed the hurdle rate, over $3 million in value moved to his children's trust, free of gift tax. Let's summarize part 1. That is how you freeze the growth. You have seen 3 methods. So the family limited partnership, or the IDGT and the GRAT, all designed to stop future appreciation from inflating your taxable estate. If you own appreciating assets, this is the first and most powerful lever. Coming up next, we will move to part 2, which is gift now. So this section, part 2, this section is all about using the current exemption rules while they are at their peak. So if you have assets likely to grow fast in the next few years, gifting now can lock in tax savings for life. Step 1, you want to use the 2025 annual exclusion. So you can give up to $19,000 per recipient in 2025, or $38,000 if you and your spouse elect gift splitting. You can fund 529 plan, custodial accounts, or family LLC units. So even small gifts compounded over time create major wealth transfer. Step 2 is about reporting properly. You can file Form 709 by April 15, 2026 to report 2025 gifts. Even if no tax is due, filing protects your audit trail and confirm exemption use. Now, let's move on and let's talk about lifetime exemption. Starting January 1st, 2026, the lifetime exemption rises to $15 million per person, or $30 million for a married couple. That means the window to make large tax-free transfer is officially open. If you expect your business or real estate to appreciate, you will want to use that early in 2026. Step 3, spousal lifetime access trust, or SLATs. So this strategy let married couple move assets from both estates while retaining indirect access to the funds. So each spouse creates an irrevocable trust for the other. So you can fund modestly in December 2025, such as life insurance or LLC interest, then contribute larger amount in early 2026 under the new exemption. They're talking about Pia and Arjun in Orange County. Their net worth is $18.5 million, tied up to an S corporation and real estate. So they create 2 slats in December 2025 and funded them lightly. In March 2026, after appraisals finalized, they gifted non-voting share to each trust. Both trusts are administered independently, and they now have long-term estate tax protection with flexibility for cash flow. Now let's move on and talk about charitable giving as a gift strategy. Gifting isn't limited to family. If philanthropy is part of your goals, charitable gifts made in 2025 may yield higher deduction than those made in 2026. You can use donor advised fund for simplicity or charitable lead annuity trust for long-term giving. I want to share an example. Dr. Elena from San Jose, she holds $3 million in tax stock with a very low basis. In January 2026, she transferred stock into a charitable remainder trust. The trust sold the share without immediate capital gain tax, pay her 6% annually for life, and will pass the remainder to charity. She paired this with life insurance and a trust to replace value for her heirs. Now let's recap part 2. That is how to give now. So you have learned the mechanics of the annual exclusion, the lifetime exemption slats, and charitable structure. So each move use current law to move assets efficiently and permanently out of your estate. Next, we will start part 3, which is shifting income. So now we shift focus from assets to income. This section helps high earners move taxable income to family members or entity in lower brackets without triggering gift tax. If you are self-employed, own a business, or have family member who help with your operation, listen closely. Step 1, family loans. Document your family loans with a promissory note at the applicable federal rate or AFR. Collect interest, require payments, and each December forgive up to the annual exclusion per borrower as a gift. This creates a steady, tax-free wealth transfer over time. Let's look at Aiko and Kailua. She earned a high salary and loaned her daughter's LLC $200,000 in November 2025 to build an ADU accessory dwelling unit. Each December, Aiko forgives $19,000 of principal as a gift. Over several years, the loan will disappear. The daughter builds equity and all records are properly documented. The next thing you can do is to hire a family member for real work. If you operate an S Corp or LLC, you can employ your spouse or adult children for legitimate work. Run payroll, issue W-2s, and document duty. They pay taxes in lower brackets, and your business takes the deduction. Let's look at Jacob and Sarah in Phoenix. They run a contracting firm. Their college-age son manages marketing and social media. They pay him a market rate wage and let him fund his Roth IRA. The business lower taxable income, and their son build retirement saving early. Now, step 3, charitable remainder trust for income shifting. When you are selling appreciated assets, a charitable remainder trust defer capital gain and provide an income stream for life. Combine it with an irrevocable life insurance trust to restore value for your heir. Let's look at an example. Dr. Elena plan revisited. So her CRT sells stocks inside the trust without triggering gains. She enjoys steady income, support charity, and eliminate estate tax on the assets. So let's recap part 3. That's how you shift income through family loan, family payroll, and charitable trust. 3 simple tools that legally move income into lower bracket and build multi-generational wealth. So next up is part 4, coordinate your business entity. So all of these strategies work best when your S Corp or LLC is structured correctly. So let's tie it all together. So step 1, recapitalize your entity into voting and non-voting share before gifting. Step 2, update operating agreements to support valuation discount. Step 3, document your accountable plan and reasonable compensation before year end. Let's look at the Gracia in Phoenix. They own Phoenix Contracting Inc. and 2 warehouses. In December 2025, they converted share into voting and non-voting classes. In January 2026, they sold non-voting shares to a grantor trust to note at the AFR rate. They finalized payroll record, accountable plan, reimbursement, and loan schedule. By mid-2026, their evaluation discount held up, and business growth continued outside their state. Let's talk about a quick recap before we wrap up. You have now seen 4 parts: free, give, ship, and coordinate. All of them work together to capture this one-in-a-generation window created by the 2025 Act. So let's finish with part 5, which is your 2025 action checklist. Here what to do between now and year end. 1. Update your network statement this week. 2. Engage your appraiser and estate attorney before mid-November. 3. Draft and sign trust document and partnership agreement by mid-December. 4. Execute all gifts and entity transfer before December 31st, 2025. 5. Prepare Form 709 by April 15, 2026 to report your 2025 gifts. 6. Save valuation, appraisal, and trust statement in one binder for audit support. So bonus tip for you: schedule a 2026 strategy review with your CPA and estate attorney by next February. This keeps your plan alive and ready for future law changes. Let's bring this to life with a quick case study. So George and Valerie from Miami, they had $18 million in assets, rental, a business, and stock. Between October 2025 and March 2026, they formed an LLC, gifted discounted shares to trust, sold non-voting unit to an IDGT, and set up a short-term grant. By late 2026, several million in appreciation have already escaped their taxable estate. That's what proactive planning looks like. Let's summarize everything we have covered. Part 1, freeze the growth to stop appreciation inside your estate. Part 2, give now while the exemption is high. Part 3, shift income to lower bracket legally. Part 4, coordinate your entity for maximum protection. Part 5, follow your 25 checklist to stay compliant and organized. What should you do right now? Before you close this video, take the 3 steps. Step 1, you can download the gift and loan forgiveness tracker and estate free workbook from our pro deduction store on Etsy to start with your own number. Step 2, you could visit assetwiteinstitute.com for detailed checklists, trust funding example, and planning guides. Step 3, subscribe and turn on notifications so you don't miss the next Sunday episode on S Corp salary and bonus strategy before the year end. These next 10 weeks can define your next 10 years of wealth preservation. Start your planning now and your future self will thank you. Thanks for watching. I'm Mia. I will see you at the next update.